Should I go ahead?
Smooth 98.1 Lagos, Nigeria world. Welcome. It is gone past 6:30, and this for Thursday morning is Business Express, brought to you by Stanbic IBTC. And today I am joined by Onome Ohwovoriole. Good morning.
Good morning, Sope.
All right. Hi, Onome. Great to have you in once more. And our guest for today, you can already see him if you are streaming up on youtube.com/smooth981FM Lagos. Today, we've got Muyiwa Oni, who has been on this show before. Absolutely fantastic to have you back, Muyiwa. And he's the head of equity research for West Africa over at Stanbic IBTC. Good morning.
Good morning, Sope. Always good to be here.
Always fantastic to have you on the show. So we've got a very robust conversation for you for the next 15 minutes. Let's see if we can crack as many of these topics as we're going to be able to. And we would love to get you in on this conversation. So make sure you send your WhatsApp messages in to 0809 444 0981. You can also use the live chat option up on the YouTube live stream, or take it to Twitter, #BusinessExpress981. Before they start making you pay for tweets, use it as well as you can. All right, so gentlemen, let's get this show on the road. Let's get the conversation started. So the focus for this is we're going to be having the bank review, right? So that is this, and we've got some other things that we'll be talking about. Onome, go ahead, take it over.
Okay, so we've had a number of earnings releases from the banks, right? Both tier one banks, tier two banks. Generally speaking, what's been the performance, and which of the bank performances has struck you the most?
So the performance has been broadly positive. So if one looks at key drivers of that performance, I think what stands out most for banks is that benefit from higher interest rates. And so if you compare the yields of banks' assets, so if you look at the interest earning assets, so the assets of the banks that generates interest income, which would be loans and advances, government securities, treasury bills, or bonds as well, and corporate bonds, and also placements with banks. If you compare that figure year on year, there's been a marked increase in yields. I think for most, the average you've seen is about a 200 basis points, so about a 2% increase in that. And that had a positive impact on net interest margins and ultimately on the earnings performance of the banks. And so this higher interest rate environment seems to be benefiting most, even though I think it's benefiting some more than others. So I'd say typically the tier one banks, which would be, or the ones I would say seem to have benefited the most, GT Bank, Zenith, UBA, and First Bank seem to have benefited the most from that higher interest rate environment, because they also typically have low funding costs. So they typically will be able to either pay less for their deposits or just have an aggregate lower interest bearing deposits on their balance sheets. And the tier two banks, FCMB, Fidelity, seem not to have benefited as much. And interestingly, Access as well haven't benefited as much, just because they seem to have a higher funding cost structure as well. And so whilst this higher rate environment seems to have been positive in general for these banks, you're seeing some benefit more than others.
Okay. Now we know that the from a cost perspective, the stocks are trading cheaply, but at the same time, because of the higher interest rate environment, right, stock market has been on a downtrend.
Sure.
Do you think it's a good time to get in, or should one hold on for that downside?
I guess it depends on your timing, right? So if you have very patient money, so money willing to stay in the market for multiple years, so 3, 4, 5, even up to 6, 7 to 10 years, then one can argue that this is a good time, because we haven't seen valuations broadly this low. So there are names like GT Bank, Zenith Bank that haven't traded this low, I would say, since I started looking at the stock market. That's pre-2005. levels. And so from that standpoint, one might argue that it's a good time to buy. But I think it's also important to understand what's driving these very low valuations, particularly for these seemingly high quality names. So these banks, historically, I would say since foreign portfolio investors started trading in Nigeria, they've held more of these banks just because their returns on equity has been higher than peers. And because of that, they seem to also be in a position to pay better dividends as well. And so they would typically have a higher dividend yield relative to their peers as well. But because of how difficult it's been to invest in Nigeria, so the whole FX situation seems to have kept foreign investors out, and the ones still stuck in still seem to be trying to run out as well. And so these names that historically have had very high ownership from foreign portfolio investors, you're seeing that pressure on them, interestingly, more than the ones not as strongly held. So GT Bank, about 4 or 5 years ago, a third of their stock ownership used to be foreign portfolio investors. Now it's down to 19%. We can argue that 19 is still quite high as well, relative to, given that the direction for foreign investors is still out. It seems that's why that pressure could continue. And so from a timing perspective, it's trying to figure out whether you want to wait until that exit is complete, which is difficult to time as well, because if Nigeria starts looking positive or more investable, then that direction could change. But in terms of valuations, I would say we haven't seen such cheap stocks in such a long time.
Okay. Then generally, what's your outlook for the banks as we head into 2023? What do you think would be the headwind for them, and how can they navigate that?
So I think the regulatory environment is still, in my view, where the banks still have to deal with, because you have I think maybe I'm trying to choose my words here. We're a very dynamic regulatory environment. It seems to be changing ever so quickly, and it's difficult for bank treasurers to plan because of that. Because it seems like, because the regulator faced with a number of challenges also seem to be putting the banks in the middle of that as well. And so you're having banks having to respond so quickly to these monetary policy changes. And it seems that's still what banks will have to deal with next year as well. And so even though from a positive point of view, one would argue that the interest rate environment is positive for the banks, but also if you think that you're still in an environment where, because rates are high, or the rates are high because of high inflation, and so banks still have to deal with cost, benefits from e-banking revenues might not come as much because there's competition coming from the telcos as well, given that PSB licensing. So there's that to deal with going into next year, because it's looking more that the telcos seem to have consolidated, or seem to be consolidating that position, and could be coming more for market share in that segment. And so I would say, if one wants to rank, the regulatory environment still is one the banks still have to deal with. So you're thinking, how do I balance my deposit so that I'm still able to keep my cash reserve ratio as low as possible, but at the same time, you want to be in a position to fund loan growth expansions. Okay.
So just to follow up on that, our audience needs what's a simple way to define cash reserve ratio? That's one. And two, do you see the possibilities of any of the neobanks being acquired by any of the currently listed entities?
So the definition of cash reserve ratio is really more the amount of money as a bank. So because the central bank is more or less the bank for banks, and so as a bank, you're required to have a minimum amount of your deposits with the central bank. And sometimes actually a tool to manage liquidity or activity in the economy as well. So if the central bank feels there's so much money in the system that is going after goods and services and driving up prices of goods and services and inflation, then the central bank decides to take a reasonable amount of that out through cash reserve ratio. So the central bank can also increase rates to discourage borrowings, but also just take those funds out. And it's typically at 0%, so it's not interest bearing. And so for these banks, so currently about 32.5% of your deposits would sit in the central bank as cash reserve ratio. So if you think about that, for banks, almost a third of their deposits are sterilized at 0%, and banks cannot lend that out or generate any revenues from that. Because as a bank, what you do is take deposits, so take money from the excess side of society and lend it to the part of the economy that needs borrowing. So that's what you typically do, or companies that need funding. But if the central bank wants to slow down that activity, then it could do that by taking more of that and keeping the central bank at 0% interest. And the second question, new banks, I think it's an interesting one. And the reason why I say so is because 2 years ago, so going into the pandemic and even last year, because of the level of attraction these banks seem to be receiving, particularly from the VC funding environment, I think it was difficult for the banks to ignore these institutions and I suppose to track these institutions as well. But I think if one looks at a number of them, particularly the larger ones, I would argue that a reasonable size of the customers are individuals already banked. So not necessarily new to the banking system per se. So it's a different situation if these institutions are new to banks, then one can see that as a compelling or see some synergy in attracting such. But if it's existing customers, maybe just a different and better technology, you can argue that banks can either acquire that technology or improve on that technology as well. So for now, I would argue that I think maybe from a service perspective, banks could learn from these institutions for sure. But I'm not sure if the scale is at the point where it becomes extremely attractive for the banks. Because for now, it seems like there are already some partnerships going on. So you find that a few institutions, a few commercial banks partner with some fintechs and try to figure out a way to lend to segments of their customers that they are not comfortable lending to. So it seems there's already some level of partnership going on right now. And I would say those banks, in my view, aren't at the scale at which it starts becoming more compelling for banks to acquire. It seems there are segments of that anyway. So for institutions, the fintechs that seem to be quite strong on the payment side, that could be an attraction for some commercial banks, particularly those that seem to be trying to focus on payment, to have a standalone payment segment. So the likes of Access, GT, those two seem to have set up subsidiaries to focus on that payment segment of the market. So those, for example, could be levels of attraction. But I would say in general, you haven't seen the level of penetration that, in my view, makes it attractive for the commercial banks.
Okay. Then last question. Almost out of time.
We've actually run out of time, unfortunately. Okay. We can have this conversation all day long, but we actually can't. Muyiwa, it's been an absolute pleasure having you on the show. Our guest for today was Muyiwa Onome, who's the head of equity research for West Africa for Stanbic IBTC. Learned a lot. And looking forward to the new Gen banks getting that skill that we need. Onome, Ohwovoriole, it was fantastic having you kind of lead the conversation and make sure you continue this conversation up on social media. So, Onome, where can we find you?
On Twitter, QUANSIMOGO. No blue ticker, and I'm not going to pay for it anyway.
I don't pay you $8 a month. That's all right.
No,
Sooner or later, you pay. Elon Musk is CEO now. Muyiwa, how about you?
Do you know, I've forgotten. I really tweet that much. I'll have to check it out.
All right then. But you can also make sure to follow Stanbic IBTC on across social media platforms to see what they've got going on and the services that they're bringing to you as well every single day. All right, so thank you so much. Business Express has come to an end. Who knew the time would go by so quickly? All right, have a wonderful day, gents.